If you deposit $1,000 in a bank, it doesn't just sit there. It immediately starts making money for the bank. And the craziest part is they're using your money to do it. Today, we're breaking down how banks actually make money and why the system is designed this way. Most people think banks work like this. You give them money, they keep it safe, and you can take it back anytime. But banks are not storage lockers. They're businesses. And like any business, their goal is simple: make more money than they take in. So when you deposit $1,000, the bank doesn't lock it in a vault. They use it. Here's the basic mechanic. You deposit $1,000. The bank pays you maybe 1% interest. After 1 year, you earn $10. But the bank lends that same $1,000 to someone else. Maybe as a credit card loan at 20%, a personal loan at 12%, or a mortgage at 7%. Let's say they lend it at 10%. Now they're earning $100. They pay you $10. They keep $90. That difference is called the interest spread. And this is the core way banks make money. They borrow from you cheaply, lend to others at a higher rate, and keep the difference. Now imagine this happening, but with millions or billions of dollars in deposits. That small percentage difference becomes enormous. This is why banks care so much about deposits. Your savings account isn't just a service. It's raw material. Now here's where it gets even more interesting. Banks don't just lend your $1,000 once. Through something called fractional reserve banking, they're only required to keep a small portion of deposits available at any given time. The rest can be lent out. When that money gets deposited somewhere else, it can be lent again and again. This creates a multiplier effect across the economy. Your original $1,000 can support several $1,000s in loans throughout the system. More loans mean more interest payments. More interest payments mean more profit. That's why lending is the heart of modern banking. But interest income is only one part of the business model. There's something even more consistent: fees. Overdraft fees, ATM fees, monthly maintenance fees, wire fees, late fees. Each one might seem small. $20 here, $35 there. But multiply that by millions of customers. It becomes billions in predictable revenue. And here's something most people don't realize. The customers who generate the most profit for banks are often not the wealthy ones. They're the ones carrying balances, the ones missing payments, the ones paying interest month after month. Debt is extremely profitable. Now let's talk about credit cards, because they are one of the most powerful money-making tools banks have ever created. Credit cards generate revenue in 4 major ways. First, high interest rates, often between 15 and 25%. Second, late fees and penalty rates. Third, minimum payment structures that stretch debt over years, keeping borrowers paying mostly interest instead of principal. And fourth, interchange fees. Every time you swipe your card, the business you're buying from pays a small percentage to the bank. So even if you pay your balance off in full every month, the bank still earns money from your spending. Credit cards turn everyday purchases, groceries, gas, subscriptions, into revenue streams. And because most people focus on monthly affordability instead of total cost, debt can quietly grow for years. Compound interest is powerful when it works for you. But when it works against you, it becomes expensive. Now let's zoom out. Banks also make money through investments, asset management services, business loans, mortgages, and partnerships with other financial institutions. Large banks invest in bonds, government securities, and other financial products that generate steady returns. They provide services to corporations. They manage wealth for high-net-worth clients. They operate at multiple levels of the financial system. But at the core, the engine is still the same. Borrow low, lend high, collect fees, scale it across millions of people. And none of this works without behavior. Banks understand human psychology extremely well. They know people are impatient. They know people value convenience. They know people are more sensitive to monthly payments than total long-term cost. They know most people won't read the fine print. The system isn't random. It's built around predictable habits. So how do banks actually make money? They use your deposits as fuel. They lend at higher rates than they pay. They multiply money through the lending system. They collect fees. They profit from revolving debt. And they scale everything across millions of customers. Banks aren't evil. They're structured to be profitable. And once you understand the mechanics, you can make smarter decisions. You can avoid unnecessary fees. You can avoid high-interest debt. You can make interest work for you instead of against you. Because when you understand how the system operates, you stop moving blindly inside it. Understand the system. Master the mechanics. Build real wealth.